I see that we have a fair number of people connecting. So this is a discussion that's going to happen in front of students in the advanced course in the Creative Destruction Lab, which we run here at CDL-Paris. The Creative Destruction Lab is located in a number of different places. In Europe, most recently, it was here in Paris, before that in Oxford, and in 5 other places in Canada, and now it's expanding also in the United States in 2 places. One of them is Georgia Tech, the other one is University of Wisconsin. And there will be more places where we set this up. It's a fantastic way to accelerate deep tech ventures from the bench in labs at universities and research centers, with the help of students and mentors. And we have 2 people here who represent mentors. At least one I see, Remy de Tonac is here as well. Hi, Remy. Remy is with the CDL-Paris group of mentors in Paris, and he wanted to see and hear what Charly has to say about impact investment and maybe about his life in Silicon Valley. Remy has also had a distinguished career in the Valley, although he's now in Aix-en-Provence, London, and Paris. So he moves around a little bit still.
I'm a spy in the House of Lords.
Yes. Yes.
Right, let us know what you hear.
We had the students connect and see the proceedings that we had. I guess it was 2 weeks ago. Remy, I think you did a fantastic job. So I want to thank you for your efforts, and look forward to see you next time again in December. But let's move to Charly, who's the main attraction here today. Charly is an impact investor, and we'll learn from him today what that means. He believes that there's a fundamental and deeper meaning of wealth that involves making a positive contribution to humanity and the planet, and that the best impact investments actually integrate a positive impact into the core of their business model. So that's very different from what we see normal venture capitalists do, and it's going to be fascinating to hear from Charly what this actually means. He co-founded several impact investment funds. One of them is Tonic with 2 I's, and that's a global network for impact investors, and they have $6 billion in assets that they're deploying, so it's not small. He also serves as a member of the Club of Rome and sits on many boards because of all the investments he's doing. And he has, as I said, quite a lot of experience from the Valley. He held executive and senior engineering management positions at Hewlett-Packard, at Next, and many others, and Ariba. And so we'll hear from him on 2 subjects today. This talk will be in 3 parts. First part will be about his experience in Silicon Valley, particularly interested in his experience working at Next and Ariba. So we'll talk a little bit about that. Then we'll move into impact investment when we feel that it's time for doing that. And then finally, there's Q&As, and we'll have about half an hour for Q&As. Everyone's good? All right, so let's get going here. And I want to start with a few questions to you, Charly, on the early days of your career. You started with a PhD in computer science from the Technical University of Vienna in Austria. Why did you move to Silicon Valley?
Great. Well, thanks, Tom, and thanks for inviting me. I'm really delighted and honored and excited to be here. And thanks to everybody who is calling in. I look forward to my discussion with Tom, and equally to our discussion and Q&A after that. You can hear my accent, which is German, and so I'm from Austria. And that's where I grew up. And that's hence I studied computer science in Vienna, Austria. And my PhD was in massively distributed systems, transaction systems, and database systems, the role that data synchronization plays in the context of different recovery methodologies. So really a little bit ahead of its time in the early 80s, because networks were just getting started, but then turned out to be the sweet spot in order to have a successful career in Silicon Valley. And before I went to Vienna, I went to Hawaii on an American Field Service scholarship. And there I met my wife, Lisa, and she joined me in Austria in the early 80s. And she's an architect. And as a professional woman, non-Austrian architect, it was difficult for her to really create a meaningful career in Austria just because of the context. And and it was not that entrepreneurial back then. It's a little better now, but I think they can still do a lot better moving forward. But in any case, she suggested, that we move to the United States. And when I was doing my research and I was an associate professor at the university, but I really was not that enthralled with pure research anyway. And so I said, okay, if we go to the US, let's go to Silicon Valley. And then I tried to get a job there, and ultimately Hewlett Packard, brought us over and offered me a job as a senior technologist, designing, architecting, and then also managing the first distributed database product that I brought to market within the first 3 years of working there.
Okay, so you went from HP, I think, to DEC, and then after a couple of years at DEC and then DataMind, I think you joined Next in 1994, and then you have advanced, so you became the director of engineering. How was it to start to work at Next?
Yeah, so after DEC, I figured it was time to go to the startup scene, which is what Silicon Valley, of course, is all about. And we were secure enough on the financial side. At that point in time, you still had to make some trade-offs, going to small startups as opposed to going to bigger companies with a smaller salary, but more upside on the equity side. And a friend of mine alerted me that Next was looking for an engineering manager. And I already had a little bit of about being a manager. It's of course by Steve Jobs after he was fired from Apple. And at that point in time, he already initially wanted to build a computer with the software, next generation workstation, and but it didn't work out the way that he wanted initially. So he just got rid of the hardware plans. And when I joined, it was just a software company. And I remember, going through the interview loops was very, very thorough, let's put it that way. And the last one was my breakfast with Steve in Palo Alto at Il Fornaio. And, he had a huge orange juice and a big muesli or something. I had some coffee and a latte, and we talked for a couple of hours. And at the end of the couple of hours, he made me an offer. And I was delighted to get this offer. And I said yes on the spot, and joined him to take over initially part of the engineering organization, and it was quite a ride. I worked with him for about 4 years.
Yeah, so it must have been exciting to work with Steve Jobs.
It was, Tom, and there's a lot of stories out there, and I was quite close to him for these 4 years because I was part of the business team. And it's true that marketing and sales had a rougher time with him than, let's say, engineering, because with engineering, we had a symbiotic relationship. Steve was not an engineer, and we were not as brilliant a designer as he was. And so we accepted him as the chief designer, obviously, and he could overrule anything that we do, but he also didn't know how to implement anything, right? And so in that sense, it was a brilliant symbiosis. And but he was also he was a difficult guy to work with once in a while, and because his standards were really, 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 really high, and so mediocrity was not something that he tolerated. And people like me, we thrived in that environment, but for others who want to have a little bit more of a modest type of environment, that would not be the thing that would speak to them. I remember, the major release that we had once for OpenStep, which is the operating system that I worked on with Steve. Major release, right? And we were like 3 weeks away from releasing it, and he comes into my office and says, "Charlie, show me the release." And I show him the release, and he just uncannily zeroed in on the 2 issues that we had. They were not bad, and he said, "Well, this doesn't work." I said, "No, Steve, it works." He said, "No, it sucks," right? So I mean, and he just said, you cannot ship with those 2 features. And I said, "Well, I don't know how to fix it." And he said, "Well, you're the engineer, go and fix it," right? And so he drew out, and I'm a pretty self-motivated guy, but he drew out of me and my teams something that we couldn't have done ourselves. And I miss him a lot these days. If we get to talk, Tom, about philanthropy and the role of philanthropy, which I think we might, then I make some more comments about what I think Steve would have done compared to the Microsoft boss, ex-Microsoft boss.
Yeah, there's not a lot of knowledge about what happened for him during his time at Next. There's movies and all that stuff, and there's the book about him, and it's always about his time at Apple and what happened there, but not a lot of information at Next. How was he during the time when you were there with him?
Well, I mean, arguably he made the biggest business mistake in not opening up the OpenStep platform to developers, and that's, I think, why Microsoft was able to garner the developer community at that point in time. And then, as a closed system, the Next OS was just not able to compete on that level for that time frame, right? I mean, but at that point in time, Microsoft Windows NT just didn't work, right? It was really buggy, and it was, and we had a beautiful OS that then stood its time. I think the code that we wrote is still functional and driving OS 10 big time, and it's the basis of iOS as well. So I'm quite proud about what we were able to accomplish. And like I said, I would not want to miss these days at all. And I learned a lot. I learned so much that I was able to deploy later in my career in Silicon Valley, and I'm very grateful for that.
Well, he always wanted the open system, no open system. It would always, always closed, and sometimes to the detriment. I was a user of the Nextcube because it was all that they had in the computer science cluster when I was a PhD student at Carnegie Mellon, and I wrote my thesis on that damn cube, and it had no applications. It had almost nothing that I could use. As soon as I had some money, I had no money at that time, I bought a workstation, and I bought an Apple. But the cube was not for people that wanted to have applications. Remy, you had a question.
At the same time, before Remy, I remember the NSA was one of our major customers, and they bought like 10,000 cubes, right? And it was hilarious when the spies came in, in there, you could tell that they were spies. And then Steve, of course, in his turtleneck and jeans and sandals, it was a picture to remember. Remy, sorry, I interrupted you.
No, in fact, it was more of a comment or testimony, because first comment is that probably we have a few common friends and maybe enemies. As I had a lot of friends at HP, and I inherited of part of the team of Next in '98, late '98, as I took over the operation of Gem Plus in Redwood Shores. And quite a few developers and the CFO of Next joined. And the other comment or funny story I wanted to say is that, as you say, Thomas, there is little about that period. And there is something that I got firsthand. I'm not even sure you know about that, Charlie, which is that, as you may remember, Steve Jobs was fired by Jean-Louis Gasset, by John Scudder, but it was Jean-Louis Gasset, the French VP of marketing, who was behind that. There was a power struggle between Jean-Louis Gasset and Steve Jobs, and he got his head. And as Jean-Louis Gasset was about to sell his operating system from BOS in 98 to Apple, he was a bit too greedy. He wanted absolutely to get 350, and he had 300, or he wanted to get 300, he had 250. And it got to the ears of Steve Jobs that this was happening. And given that he was the most hated man for Steve Jobs, he rushed to Apple and said, listen, you can have much better OS than BOS for a cheaper price. And this is how he got back into Apple as a consultant. But very quickly, he was more than a consultant.
Even so, he sold it for 400 million, and I remember about, after I quit Silicon Valley, Jean-Louis Gazet and I were on a panel together, and he was obviously became a venture capitalist, and I became an impact investor. And it was one of my first panels as an impact investor, and the audience asked, or the panel coordinator asked a question to both of us. And he said, would you invest in an entrepreneur who just wants to get as fast, as big an exit as possible? And he said, absolutely. And I said, absolutely not. And then we had a great conversation why that is the case, right? And I think we key up some of these differences between the pure, venture capitalists and maybe the pure, impact folks. And there's anything in between, of course. It's not black and white. And I look forward to that conversation. But that was Jean-Louis Gazet in 2004, I think. Yeah.
All right, let's move forward a little bit. You then started working at Ariba as a senior vice president of product development, and this is a company that was founded in '96, and the idea with them was to use the internet to improve procurement, basically doing the procurement online. This was very radical at the time. You were not part of the founders, but you joined very early in 1997, a year after. Can you tell us a little bit about your experience being part of a startup?
Yes, absolutely. And that was a rocket startup, right? So I joined, like you said, or implied, maybe 6 months after the company was founded by 7 founders. And I felt, after a while that I was treated like a founder, even so officially I was not. As a matter of fact, Paul Hegarty brought me on board. And he worked at Next as well and was the original CTO and VP of engineering. And he was more of a pure technologist, and I was a little bit more a manager. And so he knew that Ariba needed a manager, to manage the incredible growth that was ahead of it. And so he took on temporarily the CTO role and then got out of the business. Team took over the CTO role ultimately as well. So when I came on board, I talked to the VCs, the venture capitalists, and it was Crosspoint and Benchmark, some of the well-known. Ariba was an A-level company with A-level venture capitalists behind it, an A-level founding team, and so that was my big break. In Silicon Valley. That's the wish of every technologist is to do that CTO in an A-level company. And the venture capitalists, I remember, they said, Charly, at Next you managed, close to 100 people, but this we think is going to be much, much, much bigger. And so we want to pre-negotiate an exit for you if you don't scale, right? And I said, okay, well, that's fair enough, but you have to give me a chance to prove to you that I can scale, right? I mean, you don't just let me go on the assumption that I might not scale if that ever happens. And they said, no, that's fair too. And so, but it shows you that part of my negotiation was already, if I don't work out and they need to get somebody who scales better than I do, well, then I get a decent package, and that stuck in my head, And the other one was, which was a smart move on my side, looking back, they made me an offer of either 1.5% of the company and a base salary of 100,000 back then, or 1.75% of the company. And less, right? I think it was different. It was like 150 or 100, right? But a little bit more equity, like 0.25% with 25 or 50,000 less in salary. And at that point in time, I took the equity. And if you create a $10 billion company, half a percent adds up, right? And so in that sense, it shows you how it played out for me to be in the sweet spot of what Silicon Valley has been known for decades, and that's these rocket ships and exits. I then got a chance to manage, to grow the company as a senior executive, as the VP of engineering, senior VP of product development, CTO. And my team, I scaled that from 7 people to over 700 people on 5 continents within 3.5 years. I helped scale the revenue from 0 to about $1 billion in run rate in 3.5 years. And we were in the sweet spot of a major reorganization of these enterprise software companies. I architected Ariba not as an enterprise software company, but as a hybrid between an internet company and a little bit of software still on the server, but not a whole lot. And so in that sense, we were right at the cusp of a whole new business model for software. And people, well, in any case, at DataMind as well, and Next, everybody always told me that the companies that I chose to work for, they will never succeed. In this instance, it was because SAP was and Oracle not that much yet at that time, but SAP certainly was already a big company. And and I remember going with Keith Krach, my CEO, to Hasso Plattner, who was the co-CEO of SAP at the time in Palo Alto, and to do a partnership, right? And we said, okay, Hasso, here's why we should do a partnership, blah, 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 blah. And at the end of the 30-minute conversation, Dr. Hasso, in Germany, you have to say doctor. We don't say that here. He said, look, SAP is building the car, figuratively speaking. You guys, Ariba, you build the radio in the car, and we decide what music to play. So I looked at Keith and said, I don't think this is a good partnership. What do you think? And he said, no, that's not a good partnership. Now, but the point is the innovator's dilemma. We built the company from scratch on all modern technology, and it's still holding up. And the fact of the matter is that SAP has very good engineers, but the whole business model is aligned not to the internet, but to the back end office of sticky, financial software. And still, and at the end of the day, they had to buy Ariba for $4.4 billion or euros or whatever, in order to fill up their, that gap in their offering. And not because they're dumb, but it's always, I think Steve was the only one that I observed in Silicon Valley on a big scale who was able to reinvent, when he was at Apple, the business model that cannibalized its own business in order to be successful. And that is a very difficult thing to do. And SAP certainly didn't figure that one out.
So just to let the listeners understand a little bit here. So Ariba went public in 1999. So that was 4 years after it was founded, 2 years after you joined. So, I mean, saying that this is a rocket is not a mislabeling of what happened. Many of the ventures at CDL are just dreaming about doing this. And then you exited the company in 2001, and the purchase of Ariba by SAP happened actually only in 2012. Can you tell us a little bit about your experience of going IPO, if you have any insights to share there, and then why you exited the company, because you left it in 2001?
Yeah. So we were founded, I think, in '96, and then I joined in '96, and we went public in '99. Right. So that was very fast. And it was also the time of many IPOs, and we were one of the most successful unicorns at that time. But the good thing is we had legs, meaning that Ariba not only survived 2001, but it actually started growing again after 2001. That was the big technology crash, that tanked most internet companies that didn't have the legs, including I2 and PeopleSoft, and many big companies and good companies went under at that point in time. So in preparation, it was fascinating to be a player, and a senior manager in preparation for the IPO. So Morgan Stanley was the underwriter, and of course, the market maker. And as part of being the CTO, I had to talk to all the potential first buyers, so to speak. So when you do an IPO, then you prepare the infrastructure of big companies that commit to buying a bunch of shares at a certain price, if you don't, within a price range, so that that there's some volume that develops. And then, of course, us insiders were not able to diversify our stock holdings until 180 half a year after that. And so so the process of going public was an intense one, very intense. And you know, at that point in time, in those 4 years, I didn't have a lot of vacation, but it was also understood that if you're a senior executive of a rocket ship in Silicon Valley, that you don't, you know, take vacation, you know, here and there. And I did maybe one weekend a month, in 1 week a quarter, and the rest I worked, right? And my team was, like I said, distributed on all 5 continents. And I traveled once a quarter to Asia, and once a quarter to Europe, and that's quite intense. But I wouldn't want to miss that. And then, of course, when I sat at the broker's desk that morning in June of 1999 at 6 a.m. in the morning or whatever, West Coast time, when Ariba went public on the NASDAQ, it was quite exhilarating to see how successful it was and how it settled down. And then, of course, we were able to sell the first bunch of shares half a year later.
So you left at 2001. Was that when all the tie-ups were expired and you could cash out completely? Did you leave like on the day that happened, or how was it?
No. So the tie-up, you know, was already at the end of 1999. I could start selling, and as an insider, you know, it's very regulated, so you cannot really. So I just wasn't on a regular sales schedule to prove that I'm not timing the market, because if you were to time the market, of course that's illegal, right? And so there's most of the time there's some insider knowledge that you have a CTO, some merger discussion going on or whatever. So in order to insulate yourself from that, I just said, hey, X% per quarter, I'm going to diversify at that point in time, and I registered that plan, you know, officially, in order to be safe, that I'm not going to be somehow compromised by some, you know, whatever people might make up. And so I had a chance to diversify for about 2.5, 3 years, almost 3 years, as a matter of fact, before in September of 2001, the market tanked. And so I was diversified about 3/4 of my holdings, which turned out to be quite a lot of money. And then in 2001, I had managed the company through the crisis. It turns out that Ariba had 2 major products. One, I built the procurement system, and the other one was a marketplace. And the general market forced us to do a digital marketplace, and we bought TradeX. And TradeX per quarter to about 24, because it was not really a business, and procurement stayed, and we right-sized that, and then procurement was able to grow again, and then marketplaces were able to come in a little later at that point in time.
So in another talk, you've said that in 2001, you quote unquote stepped off the treadmill. What happened?
Yeah. So you know,
Thomas, sorry to interject. I tried desperately to be noticed, but you didn't check.
Oh, sorry about that. Sorry.
No. It was for Thomas, our moderator.
Yeah.
Just wanted to, Charly. By the way, you know, I was less fortunate. I was still in lockup myself when the big fall happened. By how much did the Ariba share price go down? Went down for the young people in the room to understand the magnitude of what happened in 2001, that was 5 times greater than what happened with Lehman Brothers 10 years ago. How much was it on your side?
So Ariba was valid as an internet darling, right? Meaning that when we went public, right, at the day of going public, we had a market capitalization of, I think, 4 or 5 billion. And then it went up at the craziest time to $33 billion. And then after we right-sized the company, we thought that it would go down to 1 billion, and it went down to about 500 million, to your point. So from 30 to 500 to $500 million, right? And then, like I said, it climbed back up with a revenue multiple of maybe 5, 6, 7, which, you know, ultimately, and then they sold it at $4.5 billion at the end of the day. And so you see how it went way up, way down, and then came back on where, you know, where arguably it's priced correctly, right? And that shows you how distorted the market was and how lucky I was to be able to diversify during that time frame. And so the reason why I left was actually because we got a new CEO, and I told the new CEO that I would be happy to work for another few years, you know, through the downturn. And the only thing that I would not tolerate is lying or being low integrity. And it turns out that that's who he was, and so he lied to me, and I was so disappointed, you know, that I said, well, you know, he offered me some type of bullshit job, you know, that was really not, you know, nothing that I could accept anyway. And so I quit, right? But it was almost like a forced quitting, you know, how these things go, right? They make your life so miserable that where you say, okay, I cannot do that anymore. And with and I went out, you know, I remember when I did that, I went out in the parking lot and cried because my emotional attachment, you know, people think all you care is getting rich, but that's not why we did it. I mean, it was great to get rich too, but we did it in order to make a difference. And the side effect was getting rich. And so it was not just for the money, right? It's actually for making a difference. And I put a lot of emotional energy into Ariba and into the 700 engineers that I almost handpicked by, you know, myself. And all of that, and so I was not prepared to quit, and so that was a really dramatic experience. And then it took me, Tom, you know, a couple of years to decompress and figure out what I really wanted to do. When you step off the treadmill at the height of your career, and not many men do that, then you get a lot of good offers too, and it caters to your ego and yours. Whoa, look, they want me, right? And of course they want you. And I was just ready to say no to all of that because I knew that I didn't want to be a CTO and a VP of engineering when I'm 60, and younger people should do that, and I don't need that. And I wanted to do something else, which turned out to be impact, right? And so, but it took me some time to just get off the treadmill and to understand who I am, and then moved away from Silicon Valley ultimately as well in order to get to a different energy place that had a different way of supporting, you know, my life's energy.
All right, so that's a really good way to segue ourselves into impact investment. You know, as many of our mentors in the CDL program, you cashed out from a liquidity event, and you did decide to become an investor, and currently often in startups, but you took a slightly different path than many of our other mentors. You got successfully more and more involved in impact investing, and I think now is a good time to actually explain what impact investing is. I'll let you do that.
Yeah, so is the internet okay? I see it's a little unstable. I turn off the video if necessary. Just send me a chat note if that turns out to be necessary, but it looks okay now.
Well, we are getting you are getting frozen a few times. It happened 3 times, but it hasn't been a big bother so far. So let's just keep going as it is. I'll flag if it becomes more difficult. Okay.
So I watch the chat. It's up there. I see it. Yeah, and so when we had our liquidity event, right? Meaning that you can sell stock that was illiquid and now you can cash it in. That's when usually partnerships or marriages either break apart or they cement to do something new, right? I mean, if one of the partners wants to self-actualize with meditation and yoga, and the other one wants to have the Ferrari gig and all that, it doesn't work and things break apart. And many of the couples that we have seen, you know, they go through that, and it's, you know, it's not good or bad. That's how it is. But Lisa and I, my wife Lisa and I, we were on the same page fairly early on, saying, you know, first of all, that, you know, a lot of the reason why we were rich, wealthy, is luck. Not only luck, for sure. I knew my chops, I had experience and all that, but I was at the right company at the right time, and many of my friends were not, and they were as intelligent and as good as I was, and so I didn't confuse my own contribution, with just being the only one who could do that. And we had values from the very beginning. And if you were not born rich, then usually you have values that you care about. And even back then, we cared about sustainability and really climate, and was starting to become more of a topic. And social entrepreneurs became a topic back then as well. So really a different way of looking at the economy. And so we started looking at, so we were looking at the classical way of philanthropy and the classical way of investing, and both were not right for us. And maybe Tom, I can just explain that now a little bit why, because it's sort of in the flow. So when I looked, at the classical way of philanthropy, it became clear to me that it often contributes to the big issues of our times and doesn't alleviate them, and particularly the systemic issues of our time, like injustice and inequality and climate change mitigation on time, right? And we talk about why that is the case. But if you just measure philanthropy in making real impact on that over the last few decades, it was not successful. Philanthropy has its role, and it needs to be there in order to alleviate pain points immediately for catastrophes and what have you. But if you use it to create dependencies and to create intermediaries that otherwise would not have a chance to survive and thrive, then it actually is a bad thing, because people don't want to be handed things. They want to be a partner in co-designing the solutions for them. And that's why the classical philanthropy did not work for us. And then we looked into the investment side, the classical investment side, and we said, look at that, they invest no matter what, even if they know that they create major problems immediately and downstream. And maybe we'll talk about the design faults of the system or not, Tom, depending on where you want to go. But it certainly, we saw that it didn't work. And I'm talking about the early days, and we wanted to have our wealth value aligned. Impact investing was not coined yet. And so we talked to our intermediaries, our advisors, and said, look, we want to deploy this capital differently. How can you advise us? What's out there? And it was very early days. There was only negative screening out there, meaning, particularly in the US, you had the opportunities to go into equities and just screen out alcohol, tobacco, and that's it. And we want to screen out. We want to make a positive contribution to the change, not a negative contribution by not supporting what we don't want to support anyway. And so at that point in time, microfinance was just getting off the ground, and initially we found a couple of microfinance investments that were impactful enough for us to go in, and we supported social entrepreneurs directly in Brazil, in India, in Sri Lanka, and what have you, to get our feet wet in what's now called impact investing. And we took a systemic approach and looked at the ecosystem and said, where is the leverage points for us to change the system? In a system like finances, you have 4 components, arguably. You have the supply side of capital, the demand side of capital, the intermediaries that connect the supply and the demand, and the regulatory framework that puts the regulations out there in order to make sure that things go according to what the politicians and the legal folks want. And so we looked at all these ecosystems, and then we inserted ourselves in each one of them in order to make a difference. And maybe we talk about that a little bit more in detail. I just want to frame the discussion that we saw that, okay, we need to work on all 3 things in order to figure out how to change that. And let me stop here and see, Tom, where you want to guide me.
Well, let's go into deep impact. Because I mean, the CDL-Paris branch of CDL is gearing to accelerate ventures that are going to have an important impact, potentially important impact on climate change. That's what we're trying to push. And you have your own view on this, and you call it a deep impact. So tell us about that.
Yeah, and Tom, I just consulted a little bit my notes, and I didn't answer your question about what is impact investing. So just quickly, so people actually see, there's a definition that most people actually buy into, right? And it was published 10 years ago, and it has 4 characteristics, not in priority order. First, it's an investment approach. It's not an asset class, right? So that's why we talk about impact investing across a whole portfolio, not just you can do impact investing with your cash, you can do impact investing with your private equity, you can do impact investing with your hedge funds, hardly, but there are hedge funds out there now that allow you to do that, etc. Right? Number 2, it's intentional. So the investor says, I want to do that in order to have an impact, not accidental. Number 3, it's not only about financial returns, but it's also about social and environmental returns, right? And number 4, you need to measure these returns, which is an art in and by itself, impact measurement and management. And then now people add to that sometimes the additionality, meaning that is your capital actually making a difference, or would it have moved anyway into impact? And that the stakeholders and the beneficiaries need to be involved, not just handouts. So that's the general the definition of impact, and you can do that now.
Let's continue on that, because before we get into deep impact, I notice I jumped ahead a little bit. Please explain to the people that are attending also why this is not about going to your regular advisor and asking to screen out bad investments from a particular investment portfolio. Let's say you want to have companies invested in that have good social responsibility scores or whatever, and explain to us why that's not bad.
Right, and that actually, Tom, might be a good segue to differentiate between deep and broad impact. So particularly, in the last 3 years, there has been a huge movement, in the financial industry towards what's called ESG, and that stands for environmental, social, and governance criteria. And Deutsche Bank and Goldman Sachs and all the huge players are coming in with products, ESG products, and there's proprietary ESG criteria that they use in order to come up with a score. And then we as investors could choose an ESG fund in order to do what they call impact. Now, that's not really impact, however, because it's just good management practice. So because they can, as an example, a weapons manufacturer. And so if a weapons manufacturer lots of women minorities on the board is using green steel, which is now possible to do, to produce weapons of not necessarily mass destruction, then they get a really good ESG score, right? And so you can see how they would be pulled into an ESG fund that really diversifies across all the sectors. Similarly, in the oil and gas sector, BP, British Petroleum, is getting a pretty good ESG score because it's much better than Chevron and Exxon and all the American oil companies with respect to G and even with respect to S. Yet, we would never be able, because of our values, to invest either in a weapons manufacturer or in the really dirty old oil industry. So for people like us who want to avoid contributing to that, we would not be able to invest in ESG because it's just a screen of how you measure, how you manage your company, not what sector you're in and what net positive impact you have. And so the impact investing community, which we haven't talked about, is actually investing in impact opportunities where we align with the investee to agree that over time we want to maximize the positive impact and minimize the negative impact. Every investment, including impact investments, has positive and negative impact. We just want to make sure, that it's going in the right direction, not the wrong direction. And so that is the difference between ESG or broad impact and partially deep impact, which I'll explain a little bit more. It's not just about that, but that's sort of a one differentiator. And it's not bad. It's just continuing. So even if however, it has nothing to do with systemic change. ESG it prolongs and exacerbates inequality and social injustice, and it does not solve climate change, right? And so that's the point that I wanted to make, is that if you care about these things from a systemic standpoint and not just from feeling good about yourself, then you need to do more than just ESG.
All right. So what is deep impact?
Yeah. So 3 years ago, it was clear that everybody came into our field, impact field, and claimed impact. And I was thinking about, well, either we need to coin a new terminology to differentiate ourselves from ESG and others, or we need to qualify it and then figure out, what to do about it. And I was inspired by the terminology called deep ecology. And deep ecology was coined by a Norwegian named Arne Næss in 1972. And the main difference between ecology and deep ecology is that deep ecology is non-anthropocentric. It's not human-centric. And so deep ecology does not pretend that humans are at the top of the evolutionary chain and have the right to control nature and destroy it. Deep ecology actually postulates that we're part of nature, that we're part of the universe, part of the evolution, and therefore, we need to take care of it. Because if you're part of it, almost like a spiritual tradition, but just from a ecological tradition, we cannot do that. And that deeply spoke to me as an investor, because if you just invest with your head, right, then I would argue that you cannot go deep, because then you only invest with your brain, and the brain makes up a lot of things that are really not true, as evidenced by behavioral science, I think, and the way that politics works and how we are manipulated by Google and Facebook and others, right? So it's like, our brain is very brittle on that level, and our heart is very good. And if you only invest with your heart, then you lose all your money, most likely, because you so much compassion, and yet how do you actually make money with that? And so I say deep impact investing is like investing with your soul, because you invest for humanity and the planet for longer than your own life, not only for you and your own ego. And so it's systemic in nature. It doesn't treat only the symptoms, but the root causes. And it takes a consciousness and awareness approach that is aware that humanity has a role to play that's extractive, so to speak, vis-a-vis other tribes or vis-a-vis nature. And that's what deep impact is. And now, so within the Tonic network that I co-founded 11 years ago, which is a global network of impact investors, we groups each 30 investors, where we have formed deep impact circles, and we explore these more difficult questions of, that even, like I made the point before, impact investors are knowingly or unknowingly contributing sometimes to the existing system, right? And we are beneficiaries of that as well. And it takes a lot of courage and a lot of insights to ask that fundamental question, because if we were to align all of our capital with deep impact, then that means ultimately that we don't get any return, right? Then we lose all of our capital, right? And that's the consequence. But I think that because we are at the beginning of a major transformation, that actually we'll have to solve that issue, that hopefully, and we're not black and white either on that. The 100% portfolio is both broad and deep, but we want to go as deep as possible while maintaining the liquidity constraints and the general bane of return constraints on the financial side. So that's a little bit on the deep impact side, and that we're not the only ones doing that. So and just to be clear about what's wrong with the financial system, because I never explained that. So at the core of what's wrong with the financial system is that it only serves itself to maximize its profits no matter what. And maximizing profits no matter what is not acceptable, because if the no matter what is actually pushing all the negative effects of your investments, to society, and all the positive, returns are go over to the elite and to the investors, that's not a good way of managing our resources, right? And so the fact that the economy is built on the illusion that it could actually grow exponentially ad infinitum based on a limited resource capacity of a finitely resourced planet, you don't need to have a PhD in economics or mathematics to know that that is not a viable model, right? Long term. And the economists call these bigger problems conveniently externalities. Externalities meaning that they're not part of the system, and therefore they don't need to deal with this. They call it the invisible hand of the market will deal with it, but it doesn't. The invisible hand of the market does not deal with inequality. It doesn't deal with social injustice, and it doesn't deal on time with climate dislocation, right? And so they're wrong. And the theory that we're running on is also wrong. It's called modern portfolio theory. And Markowitz, who invented it 70 years ago, he never pretended that it should be used for systemic change or for including impact. It only has to do with risk-adjusted returns for asset classes, and that's it. And yet people try to use this theory now for impact, which doesn't work, right? Of course, because it's not integrated. And so we need to reinvent a new theory of investing that puts impact, return, and risk at the same level as financial return and risk. And we're working with lots of researchers, to start doing that. But most researchers, want to maximize their number of published papers, no matter what they write about. And so there's also only a limited amount of research that we can do, but it's getting there. And we have like Zurich, Oxford, Bertha Institute, Wharton University, they all collaborate with Tonic to analyze the data set of 100+ portfolios now, where we document anonymized the impact that we have. And so now they have a data set that they can actually run regression analysis on and do statistical analysis. And ultimately, if we have a data set that's over time growing, then we could use machine learning in order to answer the questions of how do I build a portfolio for impact with a given liquidity constraints and expected returns, as opposed to the other way around. And so unless we fix the design flaws of our system, the next pandemic will for sure come, because unless you have more habitat for viruses to thrive, they will jump, right? But right now it's just so much more profitable to cut down habitat and make monocultures out of that. And if you preserve it, you get nothing for it, right? And so that's a design flaw. And similarly, I would argue that that climate change is a side effect of that we designed the economic system in such a way that it's much more lucrative to burn fossil fuels that we shouldn't burn, as opposed to leaving them in the ground. A design flaw, right? If we were to design it, the companies are not bad. It's just that they are maximizing their profits because we allow them to do so at the expense, of course, our future lives. And so my point is, unless we change the design flaws of the existing systems, we cannot.
All right.
Different outputs. So it's a little bit more data or a little bit more explanation of what's wrong with the existing system and what we would have to fix in order to change that.
Okay, so in more practical terms for the students here, it sounds like you're putting in some trade-offs in between maximizing return on investments and maximizing the ability to create a better future for the planet, so to speak, and for all organisms living on the planet. So what kind of practical implication would that have for your investment portfolio? So what are the trade-offs that you're looking at?
Well, so let's take an example of a social impact bond, for instance, right? So we would be looking at investments where you don't have to make that trade-off anymore. So you don't have to make that trade-off anymore if and only if the financial return is tied to the impact of your investment. In other words, if your investment has a bigger impact, you should get a bigger return, right? If it has a smaller impact, you should have a smaller return.
Okay, so you internalize the externality.
Yes, and so the social impact bonds were invented for that. And the first one was done, I think, 11 years ago, and we invested in that in Peterborough in the UK. And the topic of that impact bond was to reduce recidivism of male offenders who were incarcerated and then were set free and were landing back in prison after a year because they were not able to sustain a life outside for various reasons, right? And so we know that if we actually help these released prisoners job skill training, if we help them with housing, if we help them with alcohol and drug abuse programs, if they need that, that will significantly increase their chances of not going back into the prison system. But normally that's not done because it's preventative, and nobody, the system is not set up to do that. And so in a social impact bond, it's a three-way partnership between impact investors like us, somebody who manages the intervention, like I just said, connects the prisoners or ex-prisoners to job training programs and housing programs and what have you, and a government entity that if the prisoners don't go back to prison, you can put a price tag on that. And in this instance, McKinsey put a price tag on it. And just the primary savings from a taxpayer's perspective of not incarcerating a person, not talking about secondary and tertiary issues of destroyed lives and families and all that, which is harder to put a price tag on. If you only price that, right, then we could argue that if we lower the recidivism rate by a certain percentage points, then if they pay us a certain percentage in financial return, the taxpayer still saves money. So a win-win-win scenario, right? And in this instance, we proved that we were able to lower the recidivism rate after 4 years by 10%, which resulted in a 3% return on the financial side. And that was part of the contract that we did. Now, we did not do that investment, Tom, in the social impact bond to reduce recidivism, but to explore a different instrument in the financial markets that has the chance of changing the way that the system works, like we just made the argument before. And now, unfortunately, we only have about 150 social impact bonds. I'd hope that maybe there's thousands of those. If we had thousands of those, then we could layer an equity on top of that structure, just like microfinance has done. There's equity funds, on top of microfinance. You could have an equity fund on top of social impact bonds, and then that equity would actually go up and down directly with impact, right? And so why is it that they didn't scale? Well, it's too complicated to measure and all that. And that's where tokenization and modern technology could make a difference in moving forward, to actually in the next generation of products that actually tie the financial return explicitly to the impact, which would make sense.
Okay, so let's talk a little bit about that. That's an exciting new area of using tokenization. Not everyone is familiar with that, so you might want to spend a little bit of time explaining what you mean by that, and then telling us how this would be different than the social impact bonds that apparently could not scale.
Yeah, and first also let's talk about venture capital, because that came up before, and say, let's remind ourselves that venture capital, was invented in the US more for these benefits are possible because of that, and it's really geared towards that economy. And so it's optimized for a single time exit, maximizing the profits of the limited partners and the general partners that are part of the venture capital industry, right? That's the design. And now think about what we are about.
Okay, Charlie, so can you turn off your video? Well, he went out completely.
Oh, okay. That was something happened. I don't know. I don't understand what happened. Are you there?
Yeah, turn off your video, I think so, to avoid that now, and we'll just go on sound from now on.
Yeah, so I was talking about the venture capital and why it's not one-on-one that useful as the main methodology of financing impact deals, and because venture capital is optimized for a single time exit with no discernible concern about long-term sustainable impact, and what we're about is just the opposite. We want to know about sustainable impact long-term with an appropriate financial return. And so that's why different term sheets and different methodologies of doing that make a lot more sense than that. But it's not black and white, right? And so so that's one point. Now the issue with social impact bond, it's very difficult to prove your impact, right? And so if we had a way of proving impact by using, let's say, a blockchain and recording, let's say, impact events reliably on a blockchain that are immutable and cannot be changed after the fact, then you can imagine that these events can be pre-financed. I'll give you an example. I'm working with a company called Proof of Impact, and Proof of Impact is doing just that. And so we work with the Ethiopian government, let's say, on lowering mortality for expecting moms and their babies, the mortality rates of expecting moms. And we know that if expecting moms regularly go and do their checkup, that will lower predictably the mortality rate. And so every time a mom goes to the hospital, and we record that fact on the blockchain, and then the development bank, in this instance of the Netherlands, which is quite progressive, is pre-financing tens of thousands of these, and they know that will save hundreds of lives. And so this is called output. It's a very simple model, but it's already powerful in its simplicity in proving impact, right? So you don't have to go out and use a different methodology to figure out what really happened, and they can attribute that to the financier. And so now in 3 years, when we have a longitudinal data set of mortality rates, then we will collaborate more with the country of Ethiopia to correlate that data set with other data sets that they have for the UN about general health statistics, right? And then we can get to what the impact community says outcomes, right? That are more not just how many lives are saved or how many jobs are created, but really, does it make a difference in the outcome of babies, in the outcome of their expectation with respect to having a decent childhood and things of that nature. And so as soon as you digitalize an event, then you have a digital form of the event, and then you can tokenize it, which means that you can actually put a marketplace around it. And you say, well, not only do I allow sort of buying off philanthropically these events, but I enable some people to invest in these events, right? And then trade them. And so you can see how just like the analog world, you can build up a digital marketplace. It's the follow-on of what I did at Ariba, just with also think about tokenization, let's say, of real assets. Let's say, for instance, forests, right? And so there are funds out there today, that do just that. So they tokenize a forest, and then investors can actually buy and trade tokens that represent is a great example of an asset, that you can build a marketplace around it if you tokenize it, and then you can build a marketplace around it. And there's many efforts going on all over the world that do different different instances of that tokenization. And by doing that, you can involve not only the investors but also the stakeholders, all the stakeholders, if you design the token correctly, and even the producers, let's say. So we're working with IKEA on the supply chains, and to tokenize the way that that social criteria are met that IKEA has in order to sell stuff to their clientele all over the world that's produced without slave labor and without child labor. And so we go out into the factories and use the Internet of Things to instrument the events when how long people work, and that will then be fed back into real time, not just once a year by flying consultants around the globe, and with tens of thousands of factories actually instrumented, right? That is the next wave of digitalization of supply chain impact and tokenization of those types of ideas. And maybe the last bit on that, because I see we're running out of time, is I also think that the model of Google and Facebook of monetizing our behavior, without really seeking our consent, even so legally they do, and sending us advertisements that we don't really need, is not the right model moving forward. And so by tokenizing, your digital footprint, and monetizing that. Those are ideas that I think are going to come to fruition in the not too distant future.
That's really interesting. That's pretty far out, but very interesting. I wish you the best with those efforts. There are many different efforts that are needed here in order to solve the current crisis. CDL has a particular approach, of course, and it follows sort of the standard funding model of startups, but with the goal of affecting climate change. And it's a big task to do. We release 37 gigaton a year of carbon dioxide into the atmosphere, and where we should really be actually going negative on the release of the carbon dioxide, so that we're not cooking ourselves, because that's what we're currently doing. And for that, we need problems that really can scale, that can be really big. And CDL follows a standard funding model of venture capitalists, and just takes one startup at a time, one idea at a time, and tries to scale it up. I'm going to throw out this question to you. I don't want you to ask this, but some students might come back and ask this question: is this a suitable setup for addressing climate change? And I want you instead, as my final question, to address the MBA students that we have here that's attending this session, and then I'll let them come in and ask questions. Most of these students will not become entrepreneurs. Some will. Most of them will get on the employee treadmill that you got on early, and they will probably start paying off their student loans. What would be your advice to them for how to best make a difference that's going to count given their situation?
Okay, great, Tom. So if I understand you correctly, then you don't want me to comment yet on the appropriate funding model for different approaches for climate change, but really address the second question first. Yeah, okay, so let me do that. And so the good news is, right, that we don't need to all be wealthy in order to participate in the impact economy. And so all of us have banking accounts, for instance, right? And so if you ask your bank what they do with the money that you deposit, that would be a great first step. And usually the bank will say, the banking person or the program that you interact with will say, I don't know what they do with your money. And so, you know, that answer was not good enough for us in the US, where I live. And so we did the research, and then we know that Bank of America and Wells Fargo, two big banks there, not do that anymore with us. They support the weapons industry, and we don't want to do that knowingly. So why would we bank with them if that's what they use our money for, right? And we have lots of different opportunities in the US with CDFIs and banks that are actually more transparent about what they do with our money. I just turned off the video. And so ask what's happening with the money that you have, right? And then most of you will draw some pension, maybe not all, but some. If you know which pension system you're working with, or your employer is working with, ask that question. What do they do with my pension money that I will get in 10, 20, 30 years? Are they messing up the future for me and my kids? Or are they actually supporting a sustainable planet? And the pension fund manager will say, okay, you can't have both. Do you want a pension, or do you want to do good? And you say, I want to actually do both. You can now. And the EG is actually, I mean, the EU is actually at the forefront of regulating pension funds to do just that, ESG. And in the US, we have been falling behind with the last administration, but I think the next administration will again get involved in that, just like Obama too did. And finally, you know, crowdsourcing and crowdfunding platforms are coming along quite nicely. And so anybody with just a few euros will be able to participate in peer-to-peer types of lending and peer-to-peer types of equity investing, including impact investment. So that's what you can do even if you're not rich on the investment side. On the consumer side, of course, you can consume with what you can vote with what you consume, right? And we all consume a lot, or some more than others. But in any case, if you're a conscious consumer in California, where I live, there's a big movement going on, particularly amongst the next generation, to be more transparent, and they are willing to maybe even pay 5 to 10% more, for proven, sustainability in what they consume. And that's a big enough market so that they get attention and get products that they deserve. Finally,
Okay.
the lifestyle choices that we make are also important, right? Where do you go on vacations, and what do you do? What transport do you use? And we all can vote on that once we have alternatives. And finally, I think a lot of the young people, Tom, are demanding more meaningful jobs, right? And I think they're right. And that comes out of the conviction that they want to lead a meaningful life, and meaningful life includes a job, of course, right? And we need to move forward and create jobs where you don't have to make these huge trade-offs on the compensation side anymore. Of course, I think the Wall Street packages are inappropriate no matter what, but we need to move to the point where you can make a decent living, working in the impact industry. And we're slowly getting there, and having mindfully approaching your life will guide you on that deeper and deeper, depending on what trade-offs you have to make, depending on what life situation you're in. So that would be a few thoughts on that.
That's fantastic. All right, let's open up the floor for questions. Anything that comes to mind?
Hi, Charlie. Thanks for the presentation. I just wanted to go back to the tokenization. Are you just to clarify, are you basically saying that we're shifting the value of, say, the tree, instead of saying the value of the tree is how much paper we can make from it? We're saying the value of the tree is now the token, and therefore we're incentivizing people to sustain those forests in that way. Is that basically how it works?
That's a way, sort of, yes. The way that you incentivize the tokenization itself is a design issue, right? And so if you design the token such that people get the value for preserving the tree, and you instrument that, right? For instance, there's apps now that people go around in rainforests, and they measure the diameter of the trees, and they remember where they were because of GPS, right? Then you can have a longitudinal verification that indeed the tree is still standing. Therefore, you should get incentivized, and you should get some more tokens that represent the value of preserving that tree. So now I made the connection, right? How to maybe right now easy to do that, because if you get the incentivization wrong, then again, maybe the rich would only benefit from that, or only an intermediary would benefit from that. And we want to make sure that the people on the front lines, including the farmers who maybe monitor the health of the trees, would get incentivized to do that through a tokenization mechanism, for instance.
Okay, that makes sense. So you're incentivizing the stakeholders as well, like the farmers,
yes,
for example.
Yeah,
okay.
and that's why you move. That's why I made the case, not because I didn't have time to explain it, that you move beyond just the LPs and GPs of a fund, right? Because it's not a fund anymore, and people who actually provide the value, they get incentivized by the tokens. It's almost like I tried to incentivize producers in India 10 years ago in buying back equity in a distribution company that we financed, depending on how much good products they shipped. But it was too complicated. We didn't have the right technology and platform. We couldn't make it work. And again, with the tokenization, you can do these mini transactions, and people can accumulate mini equity now, right, on doing that, and then participate in the upside of the ecosystem that they co-create, right? And the LP and GP structure would never be able to do that. And then on top of that, you provide liquidity, so LPs and venture capitalists illiquid. And so if you have enough tokens around, and you allow exchanges to either fiat currencies or other tokens, which more robust marketplaces do, and we're in the middle of this now. People, if you do the homework, you will see that there's a lot going on. Nobody has gone to scale yet, except for cryptocurrency on a mini scale. but they are built on the wrong technology, and that's being fixed now too. It reminds me a little bit about the early days of e-commerce, when we were making projections and nobody believed us, and then we fell off the curve, and then it ultimately became much bigger than we thought, right? And the same is happening with tokenizations and cryptocurrencies, right? That now we're a little bit in the valley, at least from people who are not in the know. In the meantime, a lot of people are working on the next iteration of tokenization and blockchain that alleviates the scalability issues of the first generation of that, and the next generation will be able to scale.
Perfect, thank you.
Yeah.
I also had a question.
Hi, Tim.
Thank you. Yeah, hello. Thank you for an interesting talk. And I might be one of the few that Thomas says will go into entrepreneurship. I'll be joining the startup I've been helping out on over the summer. And what it basically does is it's a capacity sharing platform for high-tech manufacturing equipment to keep jobs locally, produced locally. Now, I've been experimenting with how we can measure the impact of some of our deals we have enabled over the years. And therefore, my question is, how do you go about measuring? I talked to a lot of people, and there's a lot of different definitions of what is an impact and how you measure and quantify that impact. So any advice or tips there would be interesting. Thank you.
Yeah, and Tom, feel free to give my email, charlykleissner.com, to the students who listen in here, because some of the topics do require more discussion, like impact management, right? And so, Tim, I will just give you a little bit of an overview and then maybe take another couple of questions, but we will not have a comprehensive discussion. So the way that the impact management community is working right now, and I'm saying impact management on as opposed to measurement only, because you have to go like you do with your startup in imagining what impact you could have, and then in making sure that you can actually measure it, and then you have feedback loops of what that means that you can then adjust, right, in a systemic way. So it's not just one set of measures. And the impact community is similarly interested in singular. We talked about these events, which are very simple, and the jargon for that would be outputs. So how many people are actually sharing in the equipment that you provide, and how many resources are saved because of that. You can measure, that's outputs, right? Now, how that influences really, let's say, the downstream value chain of a partner of yours that can then change their whole manufacturing cycle to adapt to a more sharing type of hardware scenario, right? That's a secondary, deeper impact that's a little harder to measure, and maybe measure qualitative. The measurement then both quantitatively and qualitative. Almost like in order to make the numbers sing, you have to put the story behind the numbers, right? And similarly, if you just have a story without numbers, it's usually not enough. It's just a story, and both are important, right? And I think ultimately, if your goal is to strengthen the resiliency of the local production ecosystem, right, then you have to figure out how to measure that, because I heard you say that. And that's a more long-term issue, right? And so long-term, is it true? So I was, I'm working in Hawaii with my wife on the resiliency of an island economy, and island economies are natural units of resiliency, and yet the supply chains and value chains are totally broken there. But now our entrepreneurs are in the sweet spot because they produce locally, and now even the politicians say, let's support these entrepreneurs, and let's measure how the local economy benefits from that local production and consumption. And that, I think that is one of the biggest leverage points that we have on the impact side, is to move from these from everything being global to just use global when appropriate, and then go back to the resiliency of local production consumption, which you are in, with capacity building and capex costs, and then the consequences of that with vis-a-vis your partners.
Thank you. It's a difficult question, and it needs a lot more
it leaves open a lot of
understanding
questions.
from my
Yeah.
side,
So yeah.
But it's a great question because we actually have several ventures in the CDL program who has the same question. We had discussions. I don't know. I mean, the discussions in the session, they flow very fast. But the mentors were discussing what is the monetization of the value to the customer of what this particular company is doing. And many of the entrepreneurs had very vague answers. And as long as they have vague answers, it's very, very hard for them to get anyone interested in funding them. It doesn't matter if it's an impact. It's a measure that shows impact beyond, rate of return in terms of externalities that are affected or not. If you can't clarify that, it's just hard to get anyone to invest in you. And in particular, if it's something that will reduce carbon dioxide production or save the planet in some way, which we're very interested in doing in this program, it is something that really needs to be included in that. And then you need to find the particular investors that are interested in actually caring about those, paying for those externalities to be reduced. So it's a difficult problem.
And I think on the environment side, it's much more plausible, and there's many more examples of when environmental externalities were actually internalized into the market, and then an investor who is not an impact investor can take advantage of the market dynamics to get a very good return. That's what happened to renewable energy, right? And when we first invested in that in the early 2000s, we didn't invest to maximize our profits. We invested in it to shorten the cycle of making it mainstream, which arguably we have done that, right? And because if we helped the industry mature with our early capital, where we didn't make big returns, now even pension funds invest in that, right? Not because they want to do good, but because it's an internality into the market. On the social side, the market does not really understand that. The market believes right now that social injustice and inequality is not material to the financial return, right? And therefore you cannot expect a financial return as an impact investor. And that's where you need subsidized capital or maybe even philanthropic capital to prepare the market for something that we think should be internalized, but the market doesn't see it yet, right? And so finding the right the right level of combination of investor is important for you entrepreneurs, right? And so sometimes it's good to have a combination of a classical investor and an impact investor, because on the environmental side, you will find that more and more. Like I said, I just made the point, on the social side, you might not, because there's not much money to be made for the normal investor, right? But on the environmental side, if you actually bring your money faster than maybe you want, and the other one will hold you accountable to the carbon offsets and things that you actually promised, right? And so in that sense, sometimes it's a win-win-win scenario to do a three-way combination. That was not possible a few years ago when impact was considered only esoteric. And now you see with ESG++, and the topic that you have chosen, you see more impact coming in, and impact being maybe not necessarily the driver, but certainly something that you put on one of your slides and don't hide it anymore, right? You lead with finances, but then you have a slide in there with impact as well, to Tom's point.
More questions?
If nobody else, I might have a follow-up.
Excuse me, may I ask a question?
Yeah, absolutely.
Yeah, Jutta, come.
I may not fully understand the concept of the impact investment approach, but how do you usually consider the negative social or environmental impact embedded in the investment project, which has the positive net impact? So
yes, so that is almost like the holy grail today. So most impact investors don't, and most investees don't. It's hard to do, right? That doesn't mean that we shouldn't do it. I think actually you're spot on. In order to really compare, apples to apples, you need to compare the net positive impact and not only the positive impact. And I mean, that would really take care of, you know, a lot of the old industries that are polluting, because if you take into account the negative impacts, then it will be clear that the balance sheet on impact is not good, right? And if you only take in the positive impact, like I made the case for ESG investments before, where only the positive impact or even the positive management characteristics are counted without the negative consequences either on any of the sites, then you miss the whole point of doing it in the first place. Now, of course, you know, impact balance sheets, so to speak, you know, many people are working on that, but there's no single methodology yet that would be very comprehensive, you know, to say everybody agrees to that. There's certain pockets in certain certain verticals where it's easier to do that, and in certain other pockets it's not. And if you then demand that societal consequences and socioeconomic consequences like poverty and income generation and wellness of life would be measured as well, then you get into a space where there's not much methodology yet available, and yet many people are working on it. You know, to give you an example on a topic that I'm a little bit more familiar with is, I talked a little bit about consciousness, right? And there's people working on tokenizing meditation, for instance, which is interesting, right? Because their theory of change is that if people, almost like the Buddhists, the monks in Bhutan, I was amazed, you know, that the society not only accepts the monks but supports them, you know, to meditate all day for the benefit of society, not for the benefit of themselves. So in that particular society, it's understood and there's consensus that them doing that is a positive thing for society, right? I think that's an exception right now, globally speaking. But that person that does tokenization of meditation has a similar theory of change, saying that eventually people will figure out that if people go into deep meditation, and he measures that by measuring the brain waves and by going into beta waves and theta waves, that's approximation of deep meditation, then you get a token. And then if people actually are valuing that token and say, I value the fact that you're meditating for society, then they provide services for that, right? And so it's a real interesting way of dealing with things that you think cannot be monetized, and maybe they will never be, but people are actually working on that because they think that it is you should be able to monetize that value to society, right? And similarly, well-being of society, which right now is outside of the GDP, it's outside of it means, you know, to measure the economic growth in terms of GDP only and pretend as if that's a proxy for the well-being of communities. It's not, right? And so so a lot of work to be done in figuring out how to measure it, you know, what it means, how to incentivize people to do that, and to reorganize our society a little bit over time to value that.
This guy wants to ask a question. Sure, go ahead.
Oh, hey. Hi, can you hear me, Charlie? Hello.
You're good.
Okay. So Charlie, just wanted to touch base upon this concept of token.
I heard it because my earpods went out. So can you start over again, please? Thanks.
Yeah. So can you hear me now?
Yeah.
Okay, so I just wanted to touch base more upon this tokenization concept. I didn't really fully understand it. Could you give us a little bit more? So my understanding is that it's all about quantification, that you put a token on an activity which people are able to comprehend in their and create a value out of it, right? Is that what you mean? And then could you give us a few more examples that how have you, like, basically in the ventures that you've invested, how have they tokenized these things, even though they haven't been able to really create a dollar value or really a quantification method? Like, what do you really mean by this tokenization concept?
Okay. So I give you one more example, right? And maybe that brings it home, I hope. So you can check it out, rainfall.io, I think. So I'm an investor in that, and I'm on the board. And what we do, I mentioned a little bit the follow-on models to Google and Facebook. And so our goal is to enable people to monetize their digital footprint with tokens. And so there are 4 billion, 3 billion Android phones out there right now. And, you know, in the global South, it's $15 for a phone. And a few gigabytes up and down is practically nothing. So everybody of these close to 4 billion users has a digital footprint. So it's not like we're talking about the future in 10 years. It's happening right now. And but right now they're not in control of their own data. So I have an Apple Watch right now, right? And I would like to control my health data. I would like to say, hey, you know, for I had cancer, and for lymphoma studies, I would volunteer my data with my name attached to it and my everything, because I want to support with my impact, you know, the research on lymphoma. But if an insurance company wants my data, then I would want to sell it. I wouldn't sell it, but if you want to monetize it, you should be able to sell that, right? And then if you want to have it longitudinally, you would have to pay more. If it's exclusive, you have to pay more. And so how to monetize your digital footprint will be a big topic, and dozens and dozens and dozens of startups are working on that topic. So to me, it's not a question of when or if one of them or more of them will be successful, but when, right? And rainfall is one of them. And so with rainfall, you know, we put a tokenization in place as we speak, and do a tokenization cell just in a few weeks, incorporated in Switzerland. So Switzerland actually understands that they want to support the new digital financial infrastructure, because they made so much money in the last 300 years in supporting the old financial infrastructure, that they actually put great, you know, that they allow foundations and corporations that are incorporated in Switzerland to allow to sell tokens to people all over the world. So that's happening now. So when you raise money with a tokenization cell, then you create the tokens. It's almost like an IPO. Instead of having, I talked about the IPO process, and at the IPO process, you have to have a market maker, and then you have to have a sort of a lineup of people who commit to trading in the first few weeks in order to create the market. The same thing in principle with tokens. You create tokens by selling them to a market maker and a pre-qualified currency called minting coins, but minting is too energy intensive, and so now we get to the second level of technology, and that's actually staking. And staking is getting away from the problems of the first generation, and we are creating a staking community on that one that is incentivized by transaction fees, just like Goldman Sachs is, or you know, whoever did our IPO, they get 7% of the proceeds at that point in time of the IPO. That's very lucrative. And so similar, we are reinventing the whole system of the old way of doing IPO with tokenization, right? So let's assume that you get a few tokens out to that process. Let's just assume you do that and you get enough demands so that's happening. That's with the IPO. Similarly, if your bankers don't believe that you have a good model that people will buy and want to get shares in your company, then they will not underwrite your IPO. And similarly, if your value proposition to a staker is not good enough, they will not stake, right? And so it's similar. And so you have to have a good business model and idea behind it. It's not only about doing an ICO, it's called initial coin offering, but really doing it that way. So let's assume that you have to, you know, in our case, I think we're putting out 40 million or whatever, you know, at a certain price that raises, you know, whatever, $8 million for the company, that then will be used to build the infrastructure and to then get people on board who would then create the markets themselves, not the currency, but the markets, the services that would be bought and sold through these tokens. And that's when in our case, we say, well, if you participate, so we're working with the Joy of Moms as a network that we put on as a digital wallet on this new tokenization scheme. They will use rainfall tokens in order to do the services that moms actually use, as opposed to working with Google and with Facebook on that. They will work with rainfall because then they can control who owns the data, and they will participate in getting tokens for services that they provide, right? And so the way to get to a marketplace, which I argued that with Ariba, it was early days and it was very difficult to do now, is if we work with these networks of people, with millions of people, if they actually commit to using the digital wallet and pay for their services in the tokens that you offer them, and you provide a mechanism for exchanging them to either fiat currency or other tokens, then you have a chance of actually creating that market. Was that a little bit more clear of how it works? Yeah. Well, I'm glad that good. I mean, it's new concepts, right? And
yes. I mean, yeah.
But it's actually, when I relate it back to my own experience as doing an IPO. And Tom, thanks for asking that, right? Because it's quite similar, but it's all digital, right? And it's not, and it has to be transparent too, because we don't want to create additional non-transparent usages. The original blockchain guys were all renegades from Venezuela and Russia and and all that, and the IBMs and everybody else in China is co-opting these now for their own control, not for democratization, but for control, because that way you can know what's going on, right? And that's really what they want. In any case, so I hope I answered your question.
All right, Dr. Charly Kleissner.
Now he's getting formal.
Technical University of Vienna. We're so glad that you've been with us. No, I didn't get formal, but
no, I'm just kidding.
I wanted to salute you for coming here virtually and helping our students understand what impact investing is and what a career in Silicon Valley looked like, working together with Steve Jobs and other luminaries. It was fascinating to hear from you and your stories, and particularly about the future of investing using tokenizations. We might have something there that might work brilliantly and be able to scale up a lot of different businesses that way that we otherwise wouldn't be able to. So let's hope for that. All right, folks, for those of you who are in the class, I'll see you on Thursday, I believe, together with Sebastian. Yes, thumbs up. And thanks very much. Charlie, thanks so much.
Thank you, Tom, and thank you all of you who listened in on this. I'm delighted to be here, and I wish you all the best. Bye-bye.
Thank you, Charlie.
Thank you so much, Charlie.
Thank you.
Thank you. Thank you. Thank you very much.